This lesson is on Wyckoff Events. So we're taking the previous lesson, which you've just watched, taking it further and making it actionable. So we talked about the events, the preliminary stop, climax, reaction, test, false breakout, breakout, and confirmation. All the events that make together to become a Wyckoff accumulation or distribution structure. Now, we're going to make it actionable. So you know what they are, but now you're going to find out exactly how and when to trade each event, right? In this lesson, I'm going to cover the first 5, which all together form the Wyckoff structures that we know and love. And the last 2, which are at the end of the structure, the breakout and the confirmation, they're going to have their own lesson, and it'll be the very next lesson, of course, as they need much more in-depth explanation, because that's when you shift out of a range and into a trend. So we're going to deal with 1 to 5 here, starting, of course, with the preliminary stop. So the appearance of preliminary stop on the chart is often misinterpreted, and the reason being is that you don't always get very clean volume analysis with it, all right? But you want to think, don't worry too much about the volume, because the most important thing is the psychology behind a preliminary stop. And you have to think, and this is the same for all events within Wyckoff, you need to think about what is the dumb money doing versus the smart money. Because at every stage in a Wyckoff structure, whether it's the preliminary stop, whether it's the buying climax, whether it's whatever, you have to remember that all it is a game of liquidity. If you've ever been on the wrong side of the market, which I'm sure you have, we all have, there's going to be times where you buy in these areas. You buy up at this point, or you sell down here. This is the single most important part of the Wyckoff event analysis, is to think in terms of liquidity changing hands. So what are the smart money doing? What is the dumb money doing? Smart money here will be positioning themselves, thinking that the price has reached a level where the trend is probably ending. So in this example on the screen, they're going to think the uptrend is likely ending. So they're going to be starting to sell, and they'll be absorbing all the buying with their own selling. And it's the dumb money traders who will be providing them with the liquidity they need, right? So the signs of a preliminary stop, volume will rise more so than it was in the previous trend. It doesn't have to be huge, but as it trended up and you start to go into the PS, you should see a quick rise in volume, especially if it's on the downside. That shows that the trend, which before was moving around uninterrupted, is now introducing and seeing a little bit of selling, okay? Above average. You have your counterparty, dumb money, transferring to smart money. And that does it in 3 ways. Through greed, fear, and by being too early. So what does that mean? The smart money want to sell. How do they sell? They're going to sell to, first, greedy traders who see the price pumping fast and then enter in FOMO. So the last 2 or 3 candles here will create FOMO. Greedy traders will buy it. And of course, the smart money are selling it to them. You will have underwater traders who've been holding losing positions for a long period of time. So you'll have some dumb money who shorted down here, thinking it was the top. They got squeezed up and they have to close, which is a buy order, which fills the sell order of smart money in the instance of an uptrend here. And you have smart dumb money, right? So as the name suggests, these guys are not dumb, they're just early. Meaning they are right that this is in fact a top and they sell. So they don't buy this, they short this. But it's their stop losses that get hit whenever we come back up for the actual climax, which we talk about next. So those are the 3 types, and they show up at all stages of Wyckoff events. So think about them. Greedy traders, traders who are offside or underwater, and the smart dumb money who are just a little bit too early. A price characteristic you'll see with nearly all preliminary stops is that the previous leg will do a 75% or even a full retracement, which is a really good early indicator of a weak trend. All right, so simply put, you have a level here and then you rally up from it. You then retrace all the way back down to where the rally started, or at least 75% like is on the chart, and then you rally higher and you create your new high. That gives you extra confidence that this second move is actually the climax, because in a true trend, you should not pull back more than generally the 0.618, which is the Fibonacci level. If you pull back further than that, this is likely to be the start of a range, meaning that the next high will be a high volume climax or just a general low volume exhaustion climax, but it will lead into a range which eventually leads to, most likely, a trend reversal. So what is the use for us in identifying preliminary stop? Well, it's the first action that stops the previous trend. Okay, so in terms of what you actually do, how do you action this? When you see a preliminary stop or you think there is one, you want to abandon the previous trend as your bias. So if you were bullish in an uptrend, the preliminary stop is your first warning sign to not be bullish anymore and change your bias back to neutral. And if you're long, the PS in an uptrend is your sign to start taking profits. If you're short in a downtrend, the PS is your first sign to start taking profits. So that's preliminary stop. Let's go now to climax. So the climax, as you know from the Wyckoff structure, is considered the top. It's not actually always the very top or very bottom. Of course, you can have sweeps, up thrusts, springs, but this is where we get confirmation that a top is likely in, right? So, important signs and things to note. Sometimes there isn't a preliminary stop before the climax. Like in the example here, often the climax can come at the end of an extended move. So you could see this small dip here. In a larger structure, this would have been the preliminary stop, which would have had a deeper pullback and a real chance to gauge it. But understand how moves end, especially in lower cap shitcoins. Often, there isn't time to even do a preliminary stop because price just keeps going higher, keeps going lower, all the way to the climax, right? So you don't always get the PS. Sometimes it goes straight into climax. From the lesson I talked about on reversals, you'll know this because you'll know that there are some reversals such as the exhaustion reversal where it just looks like a V, yeah? So they don't have time to form a PS. Similarly, the climax is not always the top or bottom. So in this example, you have a sweep, an up thrust after it. And that's a key part of Wyckoff structure that comes later on in phase B and C. What you want to look for is higher volume on the reaction than on the climax. So climax number 2 leads into number 3, which is the reaction. And you only want to confidently state that there's a climax after you've seen the reaction. So it's not predictive. Remember, from the previous lesson, you don't trade heavily in phase A of Wyckoff. So you let what you think might be a climax happen, but you don't action it. It drops off and you notice volume rising on the downside and volume rising again on the downside. Above average volume, higher volume after the climax is indicative of the climax being genuine. Think about your counterparty again. Think about the dumb money and smart money in this stage, as well as all stages, and understand that the greedy traders are always trading in the direction of the trend, meaning they're about to be wrong. So the greedy are longing at the climax even more than they were longing at the preliminary stop. The fearful are always underwater. Think of it that way. The fearful have revenge shorted in this uptrend, or they're underwater. And the early are always right, but they just have bad timing. But keep in mind those people. Think about it and say, if I was greedy right now, what would I be doing? If I was fearful right now, imagine my position was underwater, what would I be doing? And that's a really good one. Because if you can imagine yourself and say, if I had shorted the previous support, let's say we're in a downtrend, and we're at the selling climax, you say, if I had shorted the previous support, how much would I be underwater right now? Actually calculate it and say, wow, I'd be 10% underwater. So if I used anything above 10x leverage, I'd already be liquidated. So anyone who's still holding these shorts must be really panicking and ready to close. Get into the head of your counterparty. And so the actions here at climax, very similar. You have to abandon the previous trend as your bias now. If you didn't do it at the PS, you need to do it now. It's no longer an uptrend. Flip into neutral. And it's the last chance you have to take profits if you're in a winning trade. Because you cannot guarantee an upthrust or a spring. So it's your last chance. Get out if you're already in profit. And don't enter new trades here. This is important. Remember that the whole structure takes time. We're still in phase A. We're only on event 2. So, even though this can be the top or the bottom, you don't have enough info yet. So, if your structure's playing out on a daily chart, it's okay to scalp or day trade around these levels. If you think you've spotted the climax and you want to scalp a short or day trade a short in this example, then sure, if your system allows. But nothing higher time frame than that. 1 or 2 day holds at most. Because you're not sure yet. You've still got phase B, C and D all to come. Alright, let's move on to 3, reaction. So the reaction, the signs of it, it confirms the climax. And so for that to happen, the shape of the price action should change from corrective to impulse, or you should see higher volume than the last trend leg. So let's talk about those. The reaction comes directly after the climax. So you have your climax, then you drop into your reaction on a distribution, or you pump into your reaction on a accumulation, right? What do you notice? 1, the change of shape. So how does the price action actually look? In the uptrend, it was like an uptrend. Nice impulse, slow correction, nice impulse, slow correction, shallow pullbacks. Nice impulse, what happens now? We impulse down and we start to correct, as in go up, slowly. Very subtle, but once you've seen it, it's obvious. You know that there's a very high probability that this is the climax. Why? Price is acting differently. Price tells you everything. So the change of shape from corrective to impulse is one of the key ways to know if a trend has ended. And if a trend has ended, you can say the climax is in. And of course, higher volume than the last trend leg. So if you looked at this and the uptrend, the impulse, had lower volume than the reaction that came after it, much like the previous event I talked about, that's a sign as well that the reaction is valid and it confirms the climax. What do you do with this? So how do you action this? Remember, we're here to actually trade it. Well, this is the most important part, in my opinion, because the reaction becomes your range low or range high, and the climax then becomes your corresponding range high or range low. So in this example, Once you have this impulse move and you have a high probability reaction and you've seen your change of shape, you say, okay, this low, which you draw across, that's my range low. Because if the trend has ended, we are now in a range. So that becomes my range low. What does that mean? That means the climax is automatically my range high. Now what do you have? Now you have a trading range. And you know the lesson. There's a lesson on trading ranges. And you have your quarter, your 50, your 75, and your range low and range high. And so once you know you have a trading range, you know where to buy and sell at the highest probability areas. So this is the most important part of the whole structure. This sets the frame for many trades and the highest probability trades. So reactions, really study those, get to learn them. Then we have tests. So what is a test? Very simply, it's where price returns to a level that it was at previously to try and either break out or reject. So in this example, we have the climax, we then have our reaction, and then we have our secondary test, where price comes up but fails to go higher, and it has lower volume. All characteristics of a secondary test, right? So it's where price officially shifts from the trend to the range. You should see weak volume on the test, lower volume on the test than you saw on the climax. The previous strong hands have given up, right? So the people who previously were pushing the market up or down, they've decided not to bother anymore. It's too much effort. That's why you see lower volume and that's why you see failure. Another good one, another important one. The secondary test, if there's good or bad news and it fails to break the range, so in this example, if we were pumping here and there was a lot of good news and it failed to go higher, that is a very good confluence factor to confirm a secondary test, right? And let's differentiate. You have many, many tests within a Wyckoff structure. Understand that. Tests happen all the time. It's key that on all time frames, you see tests. So differentiate the secondary test and every other subsequent test. There can only be one secondary test, and very simply, it is the second attempt to break above the climax level. So the climax tested this level, then the second test of that level is your ST. Actions, okay, well, for me, personally, trading STs isn't a high probability setup. Because often, what will happen is, if you're going to trade the ST, your stop goes above the climax, and quite often you'll get stopped out because you can just get a wick, and it's still a valid ST, but sometimes it can be an upthrust, you know? Sometimes it can be a show of weakness as a test, which just means it goes slightly higher or lower to stop people out, but it's still valid. What's better, and the highest probability trade of the whole Wyckoff setups, is a test after a false breakout. And there's one on the screen here. So you have a false breakout with high volume, rejects back inside, comes back down into a test on lower volume than the breakout, false breakout. And what happens then? It confirms the range low. And then, the reason this is so good is more often than not, it trades all the way through to the range high. A test after false breakout offers you the best risk reward of any trade within a Wyckoff structure. So keep that in mind. Finally, let's look into our false breakout itself. Okay? This is what you're known in Wyckoff and what you've seen before as a spring or an upthrust. It's also a sweep, a fake out, false breakout. Okay? For this to be valid, you must have confirmed a climax. There must be a confirmed climax in the structure. And how do you confirm the climax? With the reaction and the secondary test. So you must have had all those. That's important. You don't want to trade the false breakouts until you've seen climax, reaction, and your secondary test. Because then you know you're in a Wyckoff structure, right? And so you must be in you must have phase B done, which means you have to have had the secondary test and you have to probably have had multiple other tests. Then you're into phase C, which is where you'll typically see a false breakout. And you want to do it at high probability liquidity zones. Why? Because again, the same people show up. Below a key low or above a key high, you see the greedy people trading the breakout, the fearful people panicking and closing, and of course the people who are too early and put their stops right down there where they become liquidity. You can have two types of false breakout, and it's important to talk about both. One, which is a common one that you might be used to, is just a wick. Sweeps a low, comes back in, or sweeps a high, comes back into range. Or, which you see quite a few of these in crypto, you break right down through the level, you then trade below it for a while, and then pop back inside. That one's particularly effective because the longer it hangs around outside, the more people are going to sell or short if it's a downtrend, or going to long, or buy if it's an uptrend. So keep an eye out for both of them. The wick, the sweep, it's the more common one, but you see these increasingly. What are your actions here? False breakout. Well, if you're in a trade from the range, so say you were shorting after the secondary test or whatever, this is your time to take profit. Do not hold it on. Don't try to be a hero. Don't try and be greedy. If you shorted because you think you're in a Wyckoff accumulation and you shorted up here, then when you get your false breakout, take profit. If you short the secondary test or you short any other part of the range, take profit. Because the chances are the first time we have the break of range, it's going to be a false one. Second and third and fourth breakouts are more likely to be the real breakout, but the first one, which is what we're talking about, that's the time to take profit. And don't enter a trade. New trades after it returns to range, not before. So like I said, you want it to come back into range and buy on the second test that you get after returning the range. Or in the example of this one where it hangs around below the low, you can buy on the breakthrough candle, okay? I'll explain why that is now. When you get a quick sweep of the low, some people got in, but not everyone. So it will come back for a proper test, more often than not. Remember, nothing's 100%, more often than not. But on this one, if it has broken down and hung around there for multiple candles, you can be safe in saying that whoever's wrong is really wrong. So when we break back above the level they all thought was gone, you can enter with high probability, high confidence. Especially something like this, where you get a quick wake up into it first, and then you break back inside. That's a really high probability breakout trade. So for that, of course, you need to go into your lessons for breakout trading and see all the usual things. So you go to a lower time frame, you wait for that level to break, you see the volume increase, you see the close through the level, and you go long. In example of this, you would never have went long here because you didn't get the first part. You didn't get a close inside, right? As soon as you close back inside the range, you can look for longs. And if you want to go to lower time frames, you can get earlier entries. And so that's it. That's number 5, false breakout. We'll go through next into number 6, which is the actual breakout, and then number 7, which is the confirmation.